Our next speaker is named John Pfeffer. We had the chance to chat earlier. He has an incredibly deep knowledge base on this subject. Like most of you here, John is an institutional investor by background, having been a partner at KKR during the last decade. He's been investing in crypto assets through his family office since 2016, first in Bitcoin, then in a broader profile of crypto assets, and currently back to just Bitcoin. I'm sure he'll tell you more about that. He's a rare, if not unique, example of someone with a deep knowledge of crypto whose interests are aligned with mainstream investors. He is not necessarily sipping the Kool-Aid. A lot of people that come here might have a crypto hedge fund, an ICO, something to pitch. He does not. He invests his own family's money at a family office. Many of you, I'm guessing, have seen his investment paper that he put out. It was a thesis in institutional investors' take on crypto asset investing. This thing made the rounds, went viral. If you haven't yet, it's required reading in the space. Hedge funds, bulge bracket banks, family offices, traditional asset managers, Silicon Valley's tech elite, and a lot of VCs call on him to advise on crypto assets. Please, without further ado, help me introduce and welcome to the stage John Pfeffer.
Investing, like so many things in life, is betting. And the great thing about framing decisions as bets is that it makes things real. It also focuses the mind on probabilities and possible outcomes. Today I'm going to make two basic points. First, why most crypto assets out there today are currently bad bets, and even if they end up being widely used. And second, why Bitcoin is a good bet, despite the substantial risks. Let me start by saying that this technology is real and has significant disruptive potential. Distributed ledger technology is just a way of organizing a database. It's actually been around for some time. The big innovation, the breakthrough, came when somebody, calling themselves Satoshi Nakamoto, ingeniously built on prior innovations in data structure, cryptography, and digital money to solve a hitherto critical hitch with digital money, which was how to prevent it from being spent twice without relying on a central authority. Satoshi's solution was to have independent parties, or miners, come to a consensus every few minutes on which transactions were valid and update the ledger accordingly. It got them to act honestly via a system of internal penalties and incentives that made it very expensive to cheat and lucrative to keep the ledger secure. And suddenly, decentralized, secure digital money was possible, and Bitcoin was born. Just as we had had the Internet of Data, now we had the key ingredient for the Internet of Value. And subsequently, the number of crypto assets has exploded, as you know, as developers and promoters have started to create variants of Satoshi's original invention in the form of utility protocols. Where Bitcoin set out to be decentralized peer-to-peer digital money, utility protocols are trying to be smart contract platforms like Ethereum and EOS, decentralized applications, or dApps for short, which are trying to decentralize activities or industries ranging from insurance to betting to social media. Now, right now, pretty much all of the crypto assets that you can invest in are either trying to be money or utility assets, as utility protocols. Now, in the very near future, coming months, quarters, we're going to start seeing claims on cash flows, things that look like debt and equity, royalty streams. We're going to see non-fungible tokens, digital collectibles, and those things will probably actually be interesting and may give some interesting investment opportunities. But they're not actionable today, so I'm going to focus right now on money and utility protocols. Blockchain protocols have several things in common. First, they're open source software projects. Pretty much every line of code in them can be copied freely by anybody. Protocols can be forked to create competing versions of the same software. The friction of converting one protocol's crypto asset to another protocol's crypto asset is low and tending towards zero. And finally, interoperability is going to be very high across protocols. Now, unlike a security where we could value these things by discounting expected cash flows, you can't do that with these crypto assets. Whether they're trying to be money or a utility protocol or underpinning a utility protocol, these kinds of crypto assets obey the equation of exchange. Now, in an economy, you know, the money supply, M, has to equal the economic activity, so average price per transaction times the quantity of transactions divided by the velocity V that units of currency change hands in the economy. Now, this equation must also hold true within the economy of a cryptocurrency. So what's interesting is that this equation allows us to think about what the drivers are of the value of a network of a cryptocurrency and how they interrelate. Put in terms of a cryptocurrency, the more economic activity that's denominated in that currency, the higher the network value and ultimately the value of the token or the currency. The higher the velocity, however, the lower the value of the network. We should think about all crypto assets today as venture capital bets. As with any bet, we look at potential outcomes, probabilities, do the best we can to assign probabilities to these things based on the information we have, and as we get new information, we update it. Now, a rational bet is simply one where there's a positive expected value and it's sized appropriately for the risk. Even a bet with a high risk can make sense if the potential payoff is high enough and the size is appropriate. But the high and highly correlated crypto asset valuations today in the marketplace suggest that investors consider all of these crypto assets to be substitute goods, and nothing could be further from the truth. They're all trying to become very different things with profound implications for what they could be worth in the future. Now, more generally, I believe crypto asset markets right now are irrational. While they may stay irrational for a long time, and therefore I could be wrong for a long time, I want to focus on anticipating outcomes when crypto assets will no longer just be pure objects of speculation, but will actually be used in the real economy. So let me now turn to why I think utility crypto assets generally are not great long-term bets at current valuations. Just think for a second about the utility protocol investment pitch, right? We want to develop a protocol to disrupt X industry. Give us your money for a crowdfunding. Don't say security. SEC might listen. Unlike a traditional software company, there will be no intellectual property protection, no non-competes, no non-disclosure agreements, no fiduciary duties, no one to hold accountable. Every line of our code that we write, because it's open source software, can be freely copied by anyone. Sounds great, huh? So, because protocols are open source, forkable, frictionless, and interoperable, utility protocol competitors will most likely be hyper-specialized and will divide markets into tiny fragments. The value of whatever sliver of a market a crypto asset manages to win will be divided by some potentially very high velocity. And think about it. Once the speculative phase passes, people are going to treat this stuff as working capital, and they're going to minimize its value on their balance sheet. And the implication of that is that velocities will be driven very high, and as a consequence, network values low. And if network values fall low enough, protocols may be obliged to abandon their native currency in favor of a usage fee model where the blockchain continues to function and just pay a usage fee, but in some other currency. What all of this means is that utility protocols may turn out to be pervasive and great at generating user surplus and destroying the margins and equity value of the industries that they disrupt. But they're likely to be terrible at capturing value for us as investors. Even utility protocols that are successful in terms of user adoption, I think, are likely to turn out to be value traps. And for those of you old enough to remember the reference, I actually think utility protocols could be the dark fiber of the decentralized revolution. And it doesn't sound like a great bet to me. So there's one way out of this trap, this value trap, and that is if people wanted to store their wealth in a crypto asset. And this brings us back full circle to Satoshi's original idea of decentralized digital money. Money is a ledger. Money is a ledger for keeping track of what we owe one another. And ancient civilizations devised various local forms of money, and gold was the first global one. It's our only money that's independent from a central authority, and that independence is sometimes still useful. But it's kind of amazing when you think about it. We're a spacefaring digital civilization, and yet the best technology we've come up with so far for this purpose is a yellow metal that we dig out of the ground at great human and environmental expense to melt into blocks and stick back underground. So the question of our finding a better technology to perform this function of a universal, non-sovereign, decentralized debt ledger surely must be one not of if, but of how and when. Now, from a practical standpoint, it's easy to see that there's not really a marginal value to having more than one, so we're probably going to settle on just one single dominant non-sovereign store of value. Bitcoin is the first viable candidate to replace gold that the world has seen. As sound money, it's as good as or better than gold on every front. And more than any other crypto asset, Bitcoin's very DNA is focused on immutability, decentralization, and censorship resistance, which are the things that really kind of matter most when you think about it when you're choosing a non-sovereign monetary store of value, things you care about. Also, it has the longest track record. It's been around for 10 years, functioning flawlessly. It has the most developed financial markets infrastructure around it, the highest network value, and of all crypto assets, it's really realistically the one least likely to be deemed a security. And thinking back to the equation of exchange, if people use something as a store of value, it means that they're going to hold on to it, which means its velocity will be low, and it could be potentially worth a lot. So, just what could Bitcoin be worth if it becomes a dominant non-sovereign monetary store of value, the new gold or even a new reserve currency? Well, let's build some scenarios. So the first step would be that simply for Bitcoin to displace private gold bullion holdings, okay? So all the extracted gold in the world today is worth about $8 trillion. 1.6 trillion of that is privately held gold bullion. As Bitcoin is vastly easier to store and to transact with than gold, I think we could assume, and pick your own numbers, but let's just for the sake of the math, assume that Bitcoin could end up being worth, that private Bitcoin holdings could be worth 1 to 2 times bullion holdings, and that would get us to a network value for Bitcoin of $1.6 to $3.2 trillion, compared to about $150 billion today. A second step would be for Bitcoin to make inroads as a global reserve currency. So total foreign reserves are about $12.7 trillion, 11% of which is gold, and the rest is fiat, mostly dollars. Now, while sovereigns, you can see that they would want to hold some of their wealth in the fiat currencies of their main trading partners. It's actually kind of awkward to keep it in the currencies of countries that are strategic and maybe even military rivals. I mean, we know, for example, that Russia and China chafe at the risk and indignity of storing so much of their wealth in dollars. So while there are hurdles, and clearly more hurdles to public sector adoption, I mean, I think we can all admit that, than there is to private sector adoption, it's imaginable that Bitcoin displaces some foreign reserves over time. Now, again, just for the sake of the math, let's assume that Bitcoin were to displace 25% on the low end to 75% on the high end of foreign reserves. Well, that would add $3.2 to $8.5 trillion to the network value of Bitcoin, getting us to total network value of $6.4 to $12.7 trillion. Now, as unlikely as this scenario may sound to all of us today, if one small nation were to put some Bitcoin in its reserves, or mine some Bitcoin, it could set off a domino effect that could cause other sovereigns to race to the entrance, to not be disadvantaged. And it also wouldn't be much of a stretch, in fact, maybe even easier, to imagine Bitcoin replacing or becoming the de facto currency in countries with failed currencies. All right, so what does all this mean for us as investors? Well, no doubt, betting on Bitcoin is risky. It could go to zero. But the scenarios above illustrate what it could be and what it could end up being worth, and it's a significant multiple of today's price. Purely as digital gold, right, we could get to a Bitcoin value of between $90,000 and $180,000 per Bitcoin compared, and keeping your slides up to date in crypto is a pain in the ass. So relative to 7, that's a 13 to 25 times multiple. And in the high end, you could imagine it getting to $700,000 of Bitcoin, or 100 times current levels. Now, what that means is that Bitcoin starts to have positive expected value if you assign a better than 8% probability of Bitcoin passing the relatively low bar of simply equaling private gold bullion holdings. And a better than 8% shot actually seems reasonable to me, given Bitcoin's progress so far. Now, is the probability of Bitcoin hitting the high end of the range, $700,000, better than 1 in 100? I don't know, maybe, But I don't need to worry about that today. I need to worry about whether I can reach the first threshold, and as we do that, as we move through the thresholds, we can look at the new information we have and revise our assessment of the bet. So in summary, am I saying that Bitcoin is the only thing that's going to survive from the current flurry of crypto development? Not at all. I expect the future to be hyper-specialized, massively multi-protocol, interoperable, and frictionless. But and by the way, digital fiat, I think, will be a thing and probably will dominate payments. I mean, this isn't about buying your coffee. We may have large asset classes of tokenized securities, cash flows, non-fungible tokens, and collectibles. On the utility token front, I think we're going to end up with a multitude of dApps and probably several competing smart contract platforms. But what's unclear is how any successive adoption of these utility protocols is going to translate into value for us as investors. As an investor, what interests us most right now is that Bitcoin might become a multi-trillion-dollar non-sovereign monetary store of value. Despite the risk, the upside is sufficient and sufficiently probable to make a small, long-term venture capital buy and hold unleveraged bet in Bitcoin make sense. Buy the ticket, take the ride. Speaking of which, so we're all aligned, and to make this fun, I'm delighted to announce that I'm giving 10 Bitcoin to the Sohn Foundation, subject to a 5-year holding period. Now, how much could 10 Bitcoin be worth in 5 years, you ask? Well, Neo asked, what are you trying to tell me? That I can trade my Bitcoin for millions someday? To which Morpheus responds, no, Neo. What I'm trying to tell you is that when you're ready, you won't have to. Thank you very much.